Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the numbers that make the world go round. And boy, do we have a lot of numbers to go through today with Dime Community Bancshares Incorporated. Let's just say their latest financial report is a thick one full of the kind of details that can make your eyes glaze over, but we'll try to untwist it all for you and find the juicy bits. Stick around because we're diving deep into their 2025 filings to see what they're really up to. And hey, if you are into dissecting corporate documents and want more straightforward analysis, join our Discord community. Link is in the description below. Alright, so we're looking at the 2025 annual report from Dime Community Bancshares Incorporated. This is the big one where they lay out their performance for the entire year. Think of it as the company's yearly report card. Now, they operate a big chunk of their business through Dime Community Bank, a bank that has been around for over a century. They do all the usual banking stuff like taking deposits and giving out loans not just to regular folks but to businesses and even city stuff thanks to their market area. So for the year ending the 31st of December 2025, what jumped out immediately was their net income. It was $110.7 million this year. That is a huge jump compared to $29.1 million in 2024. Looks like they turned things around big time. Specifically, their net interest income shot up by $89.9 million in 2025. That is the money they make from the difference between what they earn on loans and investments and what they pay out on deposits and borrowings. Big increase here. That is always a good sign. Now let's talk about loans. Banks always have to set aside money for loans that might not get paid back, that is called the provision for credit losses. In 2025, this provision was $43.0 million, up from $36.1 million in 2024. It seems they are being a bit more cautious, recognizing that some loans might be harder to collect, especially with those owner-occupied real estate loans. Moving on to non-interest income, which is everything else they earn besides interest on loans. This was $44.9 million in 2025, a big jump from the $4.0 million loss they had in 2024. A major reason for this swing was that in 2024 they had a big loss on selling securities, but in 2025 they flipped it around. This shows how volatile depending on security sales can be for a bank's income. Now expenses, non-interest expenses went up to $253.1 million in 2025. A big chunk of that increase was in salaries and employee benefits due to hiring more people to grow their deposit and business loan business. They also had a $7.2 million loss from a pension settlement. All these costs add up, but it is important to see if they're spending money on things that will help them grow. And finally, taxes. Income tax expense was $46.1 million in 2025. The company's overall tax rate jumped quite a bit to 29.4% this year, mainly because their pre-tax income was much higher. Let's look at the balance sheet. Total assets grew to $15.34 billion in 2025, which is up from $14.35 billion the year before. A big part of this growth was in cash and deposits with other banks, an indication that they're sitting on more liquid funds. Total net loans held for investment changed a bit, decreasing by $122.4 million. On the flip side, their securities portfolio grew. This could mean they are shifting their strategy a little, perhaps holding more safer investments while keeping their loan book relatively stable. On the liability side, deposits increased significantly by $1.16 billion in 2025. That is a really good sign that customers are trusting them with their money. They also managed to slightly reduce their reliance on brokered deposits, which are typically more expensive. Stockholders' equity also saw a nice bump, increasing by $79.3 million. This is largely due to the net income for the period. Seems like shareholders are seeing some positive movement. Now let's talk about their loan portfolio. A major part of their business is in loans for commercial real estate and multi-family buildings. At the end of 2025, business loans made up 30.1% of their total loans. That is a pretty big chunk, and it means they are more exposed if the commercial real estate market takes a hit. Multifamily, residential, and mixed. Use loans are another big piece of the pie at 31.8%. Banks loaning heavily in real estate is pretty standard, but a concentration here means they are really tied to the health of the property market in their area. And those non-owner occupied commercial real estate loans, that is another 27.3%. When banks have a lot of loans tied to real estate, they have to be extra careful about economic downturns or any regulations that might affect property values or rental income. And they themselves point this out right in their risk factors. They say their concentration in loans secured by commercial multifamily and residential real estate concentrated in Greater Long Island, and Manhattan could really hurt them if the economy or especially real estate values in that area take a tumble. It is good they acknowledge it, but the numbers show that concentration is still high. And speaking of multifamily loans, they specifically mention that regulations like rent control and rent stabilization could impact their borrowers' ability to repay, which directly affects the bank. This is a key risk they're exposed to. This is the core of their credit risk. If borrowers can't pay back their loans and the collateral isn't worth enough to cover what is owed, that is a direct hit to the bank's bottom line. They acknowledge that business loans are owner-occupied commercial real estate loans, which are a big part of their portfolio, usually carry more risk than residential loans. Now let's talk about interest rates. Like most banks, Dime Community Bankshares Incorporated makes its money on the difference between the interest it earns and the interest it pays out. When interest rates go up, they can squeeze their profit margins if they can adjust what they earn as fast as what they pay. When rates go down, borrowers might refinance loans at lower rates, which can also hurt their income. They simulate the impact of interest rate changes in something called an economic value of equity analysis. Looking at their EVE analysis for the 31st of December 2025, it seems like they are pretty well positioned. Even with a 200 basis point shock, meaning a big jump in interest rates, their economic value of equity actually increases. This suggests their mix of assets and liabilities is somewhat resilient to rate hikes. But when rates drop by 200 basis points, their economic value of equity takes a pretty significant hit, so they are more vulnerable to falling rates. And like any bank, they are swimming in regulations. They mention that their regulators, like the Federal Reserve and the New York State Department of Financial Services, regularly check their books. If regulators find problems, they can impose serious penalties, restrict growth, or even take over the bank. It is always a tightrope walk to stay compliant. In today's world, cybersecurity is a huge deal. They detail their cybersecurity program emphasizing controls monitoring and response plans. They haven't identified any threats that have materially affected their operations financially. So that is good news, but they are clearly taking it seriously. Looking at their strategy, it is clear that their future hinges on their main subsidiary Dime Community Bank. They need this bank to keep growing and attracting customers to stay competitive. They also acknowledge that this growth comes with expenses like salaries and technology, which puts pressure on profitability if growth doesn't keep pace. Another risk they highlight, which is common for many companies, is losing key people. When experienced leaders walk out, it can definitely shake things up. And yes, fraud is still a thing they admit to experiencing losses from it in the past. They have policies to prevent it, but it is something they have to constantly guard against. Digging into the allowance for credit losses again, which is their buffer for potential loan defaults. They rely on a model that uses historical data and economic forecasts. They even do a sensitivity analysis, showing that if unemployment goes up by 1%, their expected credit loss reserves would need to increase by over 8%. This shows how much forecasting and educated guessing goes into managing a loan portfolio. Something that is always on a bank's mind is capital. They need enough capital to operate and grow. If they need to raise more money in the future, it might be expensive or difficult to get, especially if the markets are not favorable. Raising capital can also dilute the value for existing shareholders, so it is a balancing act. So what is my take? Dime Community Bankshares Incorporated is showing signs of recovery and growth after a tough 2024. They clearly understand their risks, particularly around real estate and interest rates. They're doing a good job of managing their capital and deposits. The key will be how they keep managing those loan portfolios, especially the commercial real estate ones in this dynamic economic environment. It is a bank that is deeply tied to its local community, and as long as that community thrives and they manage their risks wisely, they should continue to do, alright? Alright, that is our deep dive into Dime Community Bankshares Incorporated's 2025 report. What do you think of their performance and their strategy? Let me know your thoughts in the comments below. If you found this breakdown valuable, give this video a thumbs up and subscribe for more corporate deconstructions. And don't forget to join our Discord for more talks and insights. Thanks for watching. See you next time on Corporate Decoder.